Global currency crisis, the D7 debt domino effect. 1. The crisis is global. A financial event of unprecedented scale is emerging, involving not fringe economies but the core of global finance. 7 G7 nations, Canada, France, Italy, Japan, Spain, the United Kingdom, and the United States, now all carry government debt exceeding 100% of their GDP. These aren't just red flags, they're blazing sirens. Footnote. This section introduces the scope of the crisis, emphasizing the historic debt levels among top economies. 2. Interest rates are the accelerator. What makes this situation uniquely dangerous is the interest rate backdrop. Unlike previous crises where borrowing was cheap, central banks have aggressively raised rates. This means refinancing existing government debt is now dramatically more expensive, and interest payments are devouring public budgets. Footnote. The section highlights how rising interest rates amplify debt burdens for governments. 3. The U.S. Treasury treadmill. With 30-year Treasury yields near 5%, the U.S. government is opting for short-term borrowing to avoid locking in higher costs. This tactic creates a rolling pressure cycle that exposes the Treasury to frequent interest rate shocks, further destabilizing confidence. Footnote. Focuses on the U.S. government's short-term borrowing strategy in response to high interest rates. 4. When confidence cracks, currencies crack. If investors suspect repayment trouble or future inflation, they dump a country's bonds, and then its currency. That triggers devaluation. Historically isolated, such events now threaten a domino effect across interconnected global markets. Footnote. This section explains how a loss of market confidence triggers bond and currency sell-offs. 5. Inflation as an escape hatch. G7 governments owe debt in their own currencies. This means they can inflate their way out of it, print more money to make the debt less painful in real terms. It's politically expedient but economically risky. Inflation, plummeting living standards, and collapsing investor trust follow. Footnote. Discusses inflation as a tool for managing sovereign debt, along with its consequences. 6. Central bank ping pong. The G7 central banks hold each other's currencies as reserves. If one devalues, others are forced to react to protect their trade balance and asset values. The 1967 British pound crisis and the 1997 Asian currency crisis both followed this script. Footnote. Explains the interdependency of global currencies and historical examples of cascading devaluations. 7. If one falls, all could follow. Imagine the U.S. dollar collapsing. Canada, Mexico, and China would need to respond or face export collapse. Investors managing trillions would panic, sparking a coordinated sell-off in Europe, Asia, and North America. This isn't theoretical, it's the scenario we are trending toward. Footnote. Describes how one major currency falling could trigger a chain reaction in global finance. 8. Political gridlock, economic paralysis. Debt levels are too high to grow out of, and politics are too dysfunctional to allow for major cuts or tax increases. Devaluation becomes the default option. Silent theft via inflation replaces overt reform. Footnote. Highlights the lack of feasible political solutions to the debt crisis, increasing reliance on devaluation. 9. The human cost. If currency collapse begins, expect soaring interest rates, shrinking retirement funds, and skyrocketing costs of essentials like food and fuel. The middle class takes the biggest hit. The financial elite might adjust, but average citizens face daily hardship. Footnote. Details how currency devaluation directly impacts individual financial well-being. 10. The warning is clear. We are no longer speculating. We are being warned. The IMF projects slower growth and tighter budgets. The D7 face a crisis with no historical parallel. The question now isn't if a collapse can happen, but whether governments will act before markets force their hand. Footnote. Concludes by affirming that global currency collapse is a looming reality unless preventative action is taken.